Welcome to the Broken Pie Chart Podcast, episode 216. I think it's 216. I'm your host, Derek Moore, and with me once again is my semi-permanent co-host, CEO of Zega Financial, Jay Pastorcelli. Jay, how you doing today?
Doing well, Derek. How are you? 216? Man, seems like every time I'm on with you, just the number goes up. Oh, that's how it works, isn't it?
That's how it works. It's kind of like inflation, Jay. It never goes down, never goes back to the previous level. It only sort of goes up over time, much like the podcast count. But Jay, you know what went up today? Some of the banks.
Bank earnings.
Yeah. Jay, you and I always talk about how in the end, a lot of the market comes down to what are the earnings? What do people expect the earnings to be? And I think some of the banks outperform, they outkick their coverage. Wouldn't you say, Jay?
I mean, yeah, when you look at the performance of the financial ETFs today, they were up notably, probably the biggest winners on my chart and on my list of ETF sectors that I watch. And I think there was a lot of expectation that, with the bank situation, I'm not going to call it a crisis, I'll call it a situation, that may be going on. It looks like the big banks were fine with it. There was apparently not as much concern about reserves and balance sheets. So, you had a good day today. I think today, what we have? Wells Fargo, JP Morgan, Citi. So we had a lot. And by the time this comes out, Bank of America will have reported as well, a handful of others. So, yeah, the big ones are all kind of out. And so far, looks like the potential fear that we saw 3 or 4 weeks ago might not be affecting the larger banks.
I mean, it seems like it. I wonder how much of this, Jay, is the zero-sumness of the banking industry, where did they take in Q1 from the smaller banks? Like, is this they're sort of like the tiger in the National Geographic episode where it's just eating stuff all over the place? You know what I mean? Like, is this zero-sum game? I don't know.
Where's he going with that? I don't know if deposits were necessarily up, but earnings were. Right? We could dig into each one of those if we had to figure out I think you're talking about deposits, right? So where the small to mid-sized banks would lose accounts, though that money has to land somewhere. You would assume it lands at, the JP Morgans and Wells Fargo's of the world, right? But I don't think deposits were necessarily up yet. And when you think about why the money was leaving those smaller banks, right? Why money was flowing out, it wasn't. Certainly fear, but the first thing that's the catalyst was that you could put your money somewhere else and earn 4 to 5% in, short-term bonds versus leaving it earning 0 in your bank account. And I don't know about you, but my big bank that I use is still paying me virtually nothing for cash, despite rates being where they are. So I'm not sure that they are the place to go if you pulled your money for higher yield. If you pulled your money for safety, then absolutely, I would agree.
At the same time, so the Fed has, so there's the discount window. That's where the banks can knock on the door of the Fed, the theoretical window. Do you think maybe at one point during the horse and carriage stage, people would take the horse-drawn carriage to the Fed in Lower Manhattan and knock on, go up to the window and be like, hey, we need a loan? Do you think that's why they call it that?
When you go up to the bank, it's a window. Even when you're in the bank, they call it you go to the next window, right? I mean, it's the big glass.
That's true.
Thing. I don't know why they call it the window, but it's really not a window, but maybe it is because who knows? I don't know why they call it the window, Derek. We'll find somebody that can. Maybe.
That was in a Die Hard movie too. Wasn't the Fed in Lower Manhattan? Was it Die Hard 3?
It was
Weren't
number
they breaking
3.
into the Fed? Yeah, that's right.
3. They're stealing all the gold.
All right. So between borrowing at the Fed discount window and then the Bank Term Funding Program, BTFP. What the heck is that? That's what you heard on the news, where the banks had all these bonds that were holding to maturity, and they had losses on those. And that's the program where they essentially can exchange those for par value, meaning not the market value today, but what they would mature at, and the Fed would loan them money. And Jay, over the last, let's say 1, 2, 3, like 5 weeks, I would say a lot of banks are pulling pretty good money from those facilities. And a lot of times, banks don't necessarily want to go to the discount window because it, quote unquote, is a sign of weakness. And we did see some discount window usage. I think on this podcast, Jay, I'd said at the time, I don't know what it means, but it means something, and we'll know when we know, but we know what it is now. So
you have been talking about it for a few weeks. Yep, that's true.
So I guess we're just going to have to see. Now, just because a bank uses that facility doesn't mean that they're in trouble. I mean, it might just free up their balance sheet, but it's worth mentioning that the usage is still pretty high compared to what it normally is, right?
Yeah, I mean, and so the indication here is that maybe not everybody's in the clear here. And I think if you if you saw the Warren Buffett interview that was on CNBC sometime last week, by the time you hear this, he would tell you that there's a lot of mismanagement within the banks. He thinks depositors are fine, but there's a lot of mismanagement, and I think maybe that is a reflection of that the books have been mismanaged, and it's that ends up being a little bit of the get out of jail card for bad decisions on the way you build your income portfolio at a bank. So, like, look, it's clearly. I mean, people can't see this, right? But my point is, like, when you compare this to, say, the period of early 2020, right, where you'd think that people would, institutions would need assistance by going to the discount window. I mean, we're like 4 times that usage right now in the last 4 or 5 weeks. So, I mean, just if you put this on par with what's happening today, versus what happened when we had that very quick and rapid recession in 2020, you would think this looks worse from a perspective of institutions having to go to the window to get, I'm going to say, bailed out. That's not the right term, but it's like, so it would be helpful, Derek, because as I'm stammering through this, for you to explain, like, really what happens here, right? Like, you show up at the window, you say, please take my bonds, give me par, and I'll pay you a little loan rate until, they're done. Is that the basic gist of it?
For that, discount window is a little different. Discount window is just if you want to take a loan from the Fed versus taking a loan from another member bank. That's just, and you pay a rate, and the discount window fee is somewhere around, well, I'll ballpark it around 5%. I didn't look today. That other facility is where they take that collateral, they walk it over the stack of paper and bonds, and they walk it over to the Fed and they say, okay, here's these bonds. Here's $1 million worth of bonds, but they're only worth 900,000 today because as interest rates go up, bond prices go down. Give us a loan for the full $1 million, charge us an interest rate, and here's these bonds. You put them on your balance sheet. So that's kind of how that works, Jay.
Thank you for the clarification, Derek.
Try to make it simple. But back to I do want to talk about the Fed, our friends at the Fed, I'll say. But I think the earnings on Friday, they came out as the most recent Friday, and you hit the nail on the head. I mean, they were good. They were better than expected. And just to give you an idea of the difference that will make, Refinitiv puts out an earnings scorecard every week, and they use IBS data. And April 1st, the expectations for Q1 earnings was negative 5.1% year over year. Now, between the companies that have reported, and there's not that many yet, and the ones yet to report, the loss narrowed to minus 4.8%. So just from the companies today, the actuals, and what's remaining, which is, I can tell you, there's 470 companies remaining, only 30 have reported. The loss, the year over year decline is narrowing from that. So Jay, I think that was, sometimes people are like, hey, is there any good news? Yeah, I think that was good news. So
the loss is a little less bad. Is that the good news you're going to share with us?
Well, it is. It is. I mean, they look, JP Morgan, the analyst didn't get that right, and didn't get it right in a good way, because they beat earnings.
Yeah.
Good for them.
Yeah. Good for them.
So speaking of the Fed, the other thing is, Jay, you and I both look at the meeting probabilities. We look at that. Let me talk quickly about the Fed, and then I do want to talk about this debt ceiling, because I think, is nobody talking about that, and they should. But first, the Fed. We look at the probabilities, and the probabilities based upon the Fed funds futures. So the Fed funds futures are contracts that trade in all these different months, going out from this month all the way out a few years. And the price that they trade at implies what the rate will be. So if you take 100 minus the price of that futures contract, it tells us or implies what the Fed funds rate is. Jay, the implied rate for the May 3rd meeting is, 83.2% probability that rates will go from 475 to 5 up to, so a rise of 25 basis points to 5 and a quarter. But Jay, what's interesting is, just looking at this, I know you spent some time researching this morning. The probabilities say it's 1 and then we're done, right?
There's a very low probability at this point that we see a second raise after this one in May that has a high probability, right? So it looks like we're finally at the stage where we could say one and done, but it's really one more, right, and done, because they've done plenty. Right, the probability, the most likely outcome for the June meeting is that they don't raise, and that is also the most likely outcome for the July, although the July 26th meeting looks like it starts to get a chance in there that they may cut. But still, the most likely outcome is still holding tight at that 5 to 5 and a quarter, which is 25 basis points higher than today. So yeah, I mean, Derek, there's definitely a little shift here where the market is saying higher, but not for that much longer, right? So the decline then really starts to kick in, that the most probable outcome is a cut in November, another cut in December, and then another cut, eventually in March of 2024. So, the market is saying a year from now will be 100 basis points lower than where we are today, but we still have one more raise to go. So it's interesting to see where the market has has the money bet, right? Like, I always like to use real prices in the market because that's where real money is. That's where the real money has been placed. And, this might be it for me. But by the way, I don't think you and I would disagree with, right? Like, I think you and I have been saying the impact of the Fed has already been in there. They could, hey guys, you've done the job, right? You're kind of done at this point. There's no harm in slowing it down. Could always start up again.
Yeah, I mean, and you and I would both agree that the Fed never even had to raise rates at all. And I shouldn't say at all, but like, the inflation was not caused by the Fed. I'm sorry. Inflation was caused by the fiscal policy sending out massive amounts of money into the economy and supply chain. And when you have supply chain problems and then you throw money out into the economy at the very point where people can't get stuff. But I digress, Jay. And I will remind people that, we were on air probably a year ago, and the Fed funds probability said that rates wouldn't get north of 3%. And so I think you rightly point out, this is what the market right now, what they are saying by their actions, by buying and selling futures contracts, of what the market implies what rates will be. But the market's been wrong before, Jay. We'll see if they're wrong this time or not.
I mean, they've been wrong for a lot with this current cycle that we're in, right? So you're right. We shall see. We shall see. And look, this is it's a reaction to news too, right? It's trading. It's active. It's futures trading. Like, it's certainly not the end all be all. I mean, why not listen to what the Fed is saying themselves, right? And they tell you what they intend to do.
Well, isn't that how banks got in trouble though? Like 2 years ago, if or a year and a half ago, if you said, well, listen to the Fed, and the Fed's saying, no, it's temporary inflation. No problem. We're still buying mortgage-backed securities. We're still buying treasuries every month. We have no plans of raising rates. So like, if you're running the bank book, wouldn't you be like, okay, well, the Fed's telling me they're not going to raise. I'll just buy these 10-year maturities at 1%. All good, right?
Come on. Yes, fine. I guess so. You take it with a grain of salt.
By the
Fair
way,
enough.
speaking of Fed speakers, Fed Governor Chris Waller was quoted saying, because financial conditions have not significantly tightened, the labor market continues to be strong and quite tight, and inflation is far above target. So monetary policy needs to be tightened further. Jamie Dimon, I don't know if he said this on the earnings call, but I saw this online, and everything is true online, Jay, as we know. He says people need to be prepared for the potential of higher rates for longer. If and when that happens, it will undress problems in the economy for those who are exposed to floating rates. So, I mean, it's possible that they're done next month, and then who's to say they have to lower? I mean, if the economy's doing well, I suppose there's no reason to lower. Fed's Waller is saying, but look, I mean, the Fed at Jay all along has said, no. I mean, even Powell said, we're not cutting. He was a little bit terse, I guess. Is that a word? Abrupt with that reporter who said, we're not cutting.
Yeah.
So this is what people are saying. We'll see what happens though, right?
And just if I could maybe digress a little on rates here, when you think about the impact that the Fed has, right? We've talked a lot about it, and the first thing that they impact usually is the housing and real estate market because they dramatically impact mortgage rates. And we saw that when they cut rates in 2020, and we see that now when they raise rates in 2022 and 2023, how they are, slowing down that sector of the market, right? I would definitely say, there is a recession going on in that section, that portion of the market. But what I hadn't thought about as deeply, and maybe when I think about really how they can impact, the end consumer. What Jamie Dimon is talking about there, about those who are exposed to floating rates, you could include credit cards in that conversation, can't you? Right? Because credit cards will adjust rates based on underlying however they're. I forget. They all kind of use a little different process there. But if you have credit card debt, this ends up being a way of really stemming your spending habits, at least if you're doing it on borrowed money, right? Would you agree with that?
Yeah, let's touch on this now because we had this plan later, but I think it's appropriate now. And then we'll go. I want to talk about the debt ceiling. I want to talk about the 3-month 10-year inversion. But Jay, credit card interest rates. This is a chart from Charlie Bolello on Twitter, and he said 20.09% is the U.S. average credit card interest rate. Wow, that's high. He points out that 20.09%. March of 2022 was 14.56%. The lows were around 11.8%. Going back, the scale is a little bit tough to see on this, but call it 2013-ish, somewhere around there. But
I think even farther
Jay,
back, right?
Yeah, I mean it's pretty high. I mean, you go back to second quarter of 2000, and maybe it's 16.5%, something like that. Jay, this is really high. Like, I think you're right to bring this up. So this constrains spending, right? And it causes people to get to the ceiling.
It has to, right? At some point. And look, there's going to be plenty of people that fall under this, right? And this, I always say this is the worst debt to carry, which is credit card debt, right? I mean, it's just difficult to get out from under a 20% rate when you're trying to pay off a credit card. So yeah, I mean, this is high, and this may impact the consumer more than than previously discussed, because once you've gone through the money supply, the banking balances, you're doing it on credit cards, and if you're not paying them off, it will force you to stop spending because you'll be paying financial institutions.
I'm just thinking out loud, but isn't, like, if you have a balance and you're paying 20%, and that's compounding. So obviously if you're only paying the interest, that interest, you never really attack the debt. But like, if you have money on a credit card paying 20%, is it fair to say that if you pay that off, you get like a 20% return? I guess it doesn't work exactly like that, but it's kind of like that, right?
I mean, you say yeah, it's we've heard that argument, right? The greatest way to give yourself a raise is pay off whatever is costing you monthly payments, right? And if it was costing you 5,000 a month on a credit card payment, and you pay it off, and you no longer have it, you have 5,000 extra in your pocket each month. It's having the money to pay it off that's the hard part. And in the past, there was the argument, well, could you do better investing or doing something else with that money, and make more than than you would. Then you'd be paying interest on. That might make sense. But at 20%, it's hard to find stuff that's going to yield you a return greater than 20% in this environment.
I think one of the issues too, and then we'll move on from this, is it does cause people to go up against the available credit faster. And for the people who most need to tap credit cards to cover daily expenses, if that line of credit is not available, it starts to be not a great situation. So, but yeah, I agree. Credit card debt is not great.
And balances are kind of on the rise, right? Credit card balances, another kind of revolving debt is starting to approach. Like, I'm looking at a chart you provided me, like approaching $1 trillion, right? The high.
Yeah, this is consumer loans, credit cards, and other revolving plans, all commercial banks, Jay. Yeah, coming up on $1 trillion.
Yeah, I mean, as a reference, pre 2020, that number was around 850 billion, right? So we are well past that. So we have more debt now than 2020. You could look at you go back on this chart, and it's one of those things that it's definitely going up and to the right. But so you got the highest rate that we've had on record, and now you've got this highest balance. I feel like we should buy the credit card companies at this point, Derek. Like, I feel like MasterCard, Visa, and Amex.
Not a recommendation, Jay. That's why we buy the whole market. We hedge.
Oh,
and
right,
of course,
right.
yeah. No, individual stocks are really tough. We should do an episode once where we just explain how difficult it is to do individual stocks. By the way, if you want to know
all of our success stories on picking individual stocks.
If anybody wants to know how we invest, by the way, and how we run portfolios, derek.moore@zegafinancial.com. That's DEREK.MOORE at Z as in zebra, E as in Eddie, G as in George, A as in Apple. Financial's up to you to spell correctly. Jay, it is interesting too that with all the stimulus, that fiscal money that I talked about, this went from about, I'm ballpark at 850 down to 750 billion. So people use that money to pay off debt, but now we're at high amounts of debt. Yeah.
And now not so good.
Not so good. All right. Well, speaking of debt, the debt ceiling, Jay. And so to set the stage for this, I'll do this really briefly. The U.S. has a debt ceiling. And that means that there's a law that was passed at some point, and the law was designed to stop excessive spending and stop spending more money than we have each year, and every year we do that. Well, I shouldn't say we; it's politicians who do this in Washington, D.C. And what happens is every once in a while, our debt gets up to that ceiling. And what typically happens is one party does, they argue about it. And by the way, Jay, if you ever want to see how shallow politicians are, you go and you look and you see what one party says about the debt ceiling when the other party's in power, and then you flip it. They say exactly different things depending upon who's in the White House. It is uncanny. And politics.
What, you think politicians aren't always honest and genuine?
I mean, if you the hypocrisy
is that what you're saying, Derek?
Sorry, yeah, it's Friday. I'm a little punchy here. I mean,
I know both of us.
The hypocrisy of politicians couldn't be further displayed than when you deal with the debt ceiling. So anyway, they're coming up against the debt ceiling again. This part of me says that the market. I have two things on this. First says, I don't think we're hearing enough about this because in the past we've seen some volatility when you start to get up to that period where they have to do something or quote unquote. The other part of me says that a lot of the hysterics on this are not correct. And there's different levers and things like that. But Jay, is this like, why are we hearing more about the debt ceiling? It's August that in theory they'll run out of money, right?
Yeah. It's a little ways away. I think it's going to be used as political ammunition, like you said, when it's appropriate. This seems a little early for that. Listen, there's, a lot of folks talking about, like, the debt ceiling helps us make our payments on, spending we've already committed to, right? It doesn't mean new spending. It's stuff we've already voted on and approved. But uh, look, Derek, it's not the most important thing spooking the market right now, right? Like, you and I both have talked about how there's plenty of media outlets that will focus on the thing that gives you, gets the most eyeballs and most ears paying attention to what they're saying. And right now, this seems so far away. And I don't, is it? I know that it'll get spun as this time is different. Will it really be? We don't know. I think you and I would probably say probably not different. This will probably get resolved. But, I think that's generally the gist. There's a little bit of, weariness around this topic. It's not interesting yet. It'll matter when it matters. It doesn't matter yet.
I always give the Greece example. Do you remember when Greece, I forget what year, Michelle Caruso Cabrera was still at CNBC. So it probably was 2015, maybe 2016, where she'd be outside, the Pantheon in Greece doing the live shot. And that was the big thing. Greece was going to default on their debt. Greece's debt to GDP today, or in 2022, was 252% debt to the GDP. That is way higher than it was back in, let's say, 2014, when it was still really high, but it was 189%. My point of this is Greece, from a debt to GDP standpoint, is in much worse shape today than they were back then. But I don't know about you, Jay, but I have not seen one person talk about this, the Greek debt to GDP, much less do live shots daily from Greece. It matters when it matters. To your point, Jay, right now, this doesn't matter. And, the debt ceiling doesn't sound like it matters to the market yet, right?
Not yet, but it will. It will. It'll definitely start to get some time and attention. And, like, let's talk this out a little bit, right? If we're gonna, so what will happen when it does matter, right? We've had some times in the past where the U.S. debt was, I guess, sometimes one time in the past the U.S. debt was downgraded. And what does that do when a bond is downgraded, Derek? What typically happens?
Well, what typically happens is the bond price goes down and yields go up.
And the rate goes up, right?
Yeah.
So, is that what we're going to expect as we're coming into, July, right? June, July? Do we expect rates to go up because of fear about, the viability, the credit worthiness of U.S. debt? Could be. And what would drive that, right? You'd get folks selling bonds out of worry that, that they won't be repaid, right? That there'll be a problem, that there'll be a default on their debt, or the value will just drop and you don't feel like writing that, right? If you don't want to ride through that. But I don't know. We should, when you look at the Fed funds futures, as we just talked about, there's no hint that, rates are going to go up during that time. But again, it's a market price versus the Fed rate. But my point is, if we want to know what it looks like, if this was really going to matter, it's a drop in the value of bonds, which is a push to higher yields.
Yeah, I mean, I will say that after that downgrade, so I think it was Moody's that downgraded from AAA to whatever the one right below AAA is. I always forget S&P uses, AAA, AA. Moody's, I think, uses like AA, B1. They're just a different scale. I think the other thing too, it's important to remember is when you watch media outlets and they want to start to get eyeballs and they want to start to scare people on this. People have to remember that the government takes in revenue. They're taking in tax revenue. They're taking in revenue every day. Like when you buy an airline ticket and there's a fee on there, and there's 28 different fees when you rent a car. Some of them fed, some of them state, some of them I don't even know where they go. Who knows? But there's money flowing into the Treasury, and the U.S. Treasury can prioritize what they write the checks to. So they could prioritize and they could say, we're going to pay the interest payments on our treasuries, and maybe we're not going to fund the $1 billion study of some rare spider. What happens to that spider if they watch New York Mets highlights for 24 hours a day for 2 weeks? So maybe we don't fund that study. And I'm halfway joking about that, but you could do a whole podcast on the ridiculous stuff that the U.S. government spends money on. There was an Atlantic article by John Carney back in 2011, Jay. I actually found it. And one of the things that he argues is, the Treasury has a quote unquote checking account, I'll call it, that sits at the Fed. It's where they, in theory, write their checks out of. I'm oversimplifying it. And it is noticeable that it's down lower than it's been recently. But John Carney made the point that it's never been tested, but why couldn't the Treasury write a check and have overdraft protection at the Fed? And essentially, let's say they wrote a $500 billion check. The Fed would just sell $500 billion worth of bonds in their balance sheet, and the Treasury would sort of have an IOU to the Fed. So
it would be bad if your IRS refund check bounced, right? That'd be pretty.
I think that would be upsetting to some people. I think that would be. But my point is, look, we could. There's other people. There's economists who are really strong in this. I'm not an economist, and I'm not. I think we'd put a lot of people to sleep with the minutia on this. But the point is, like, in my opinion, when you hear hysterics on this, it's not as it seems always. But yeah, I think it's something to keep an eye on, Jay. When it starts to matter, it'll matter.
Well, I'm sure it'll come up, and it'll be the political hot potato for a little while for sure.
All right. The other thing I want to talk about is it getting serious? Question mark. The 10-3 yield curve inversion, Jay. This is where the 10-year, 3-month, we look at 10-year Treasury bond yield and the 3-month Treasury bond yield, and you take the difference. And the reason why this is kind of important is it's predicted kind of all the recessions. So let me kind of set this up, Jay, and I want to get your thoughts on this. As of we don't have the close today, but I think as of yesterday, it was minus 1.65, which means that 3-month Treasury bills were yielding 1.65 above a 10-year Treasury. So it's inverted. The short end yields are higher than the long end yields. And Cam Harvey is, I don't know if he's an economist, if he calls himself an economist, but I know he teaches at Duke University. And Cam Harvey did a paper in the 80s. And when he wrote it, he basically said, anytime we have this 3-month, 10-year inversion, a recession tends to come after that. And since he wrote the paper, I think there's been, there were 4 before he wrote the paper, and then there were 4 after. So it's sort of like 8 for 8. And this goes back to 1968. I will say that I've talked to some people, some friends of ours who we respect their opinions. And I said, is the steepness of the curve mean anything? And I don't think there's anything to say that how steep it is. But Jay, looking at the graph I sent you and looking at the steepness, meaning how much further front month or front 3 months is above the 10-year, it's getting really steep. Are we assured a recession because of this? Like, what are we to make of this?
I mean, the bond market is certainly bracing for that. And I think a lot of times the assumption here is that when you get a recession, the Fed will lower rates, and that's why the farther out bond has a lower yield than the near term bond, right? I mean, that's the point. It's like, hey, bonds will not be paying treasuries will not be paying 5%, in 3 years from now, right? Or 2 years from now, or 10 years from now. And that's why that inversion occurs. So, look, do I think that the bond market is forecasting a recession? Well, I mean, I think a lot of people are. So, fine, I'll say that. But really, when I see this, Derek, I'm going to push back on you on this from 2 points, is I think what it's really doing is saying rates will be lower in the future than where they are today. I don't necessarily mean I think that has to come from a recession, right? The reason why that farther out bond yield is lower is because the bond market is projecting rates will be lower in the future. So I think the Fed could lower rates without there being a recession. Like, I think that's possible, right? I don't think the Fed wants to keep rates as high as they are for too long. The Fed has said they'd like to be at the 2.5%, 3.5% range. They think that's the right number for a 2% inflationary environment, which is their target. So, what if inflation fixed itself? Would they lower rates? Probably, because they're trying to tie all those things together. So, while the curve has preceded recessions, I think it's because the Fed has ended up lowering rates during recessions. By the way, what has the Fed told you? They're not going to lower rates, right? We're keeping rates higher for longer. We'll see if reality is there. So I just think, Derek, I don't think it means recession is coming. I think in these scenarios, when you had this inversion of the 3-month and the 10-year, that you got a recession after it. I'm going to tell you something. The recession of 2020 had very little to do with anybody predicting that that was going to occur. Right? I'm avoiding the words associated with what happened in 2020. But look, no, that was not in the cards. And it was a very quick recession. When I look at some of the other data points on here, like you barely got negative in, 1989, right? And yes, then you had a recession in 1990. So, like, yeah, okay, you're right. I feel like it's convenient data right now. And it may be true. You and I both said we might be in a recession right now. But I'm not sure that you have to say this is like a fail-safe thing. I think the market is telling you rates are going to be lower in the future than where they are today. Then you can interpret what causes that.
Cam Harvey, and I read some of his stuff. I'll put a link to it in the show notes. He actually put something out July of 2019, and in there he sort of addressed, hey, do you really think there's going to be a recession again? The idea is that when he did his paper, he found that when the curves were inverted, it tended to show weakness, and he's actually said, even though it's 8 for 8. It's possible that it's not right this time. Now, I looked and I looked at an interview that he did, and he said he's not sure it's going to be a really hard landing, but it doesn't mean we couldn't have a mild recession. Like, he's actually saying that this time could be a little bit different. And but you mentioned 1990, Jay. Just because you have a recession doesn't mean that it has to be really bad. 1990, July
That's fair to
1990.
say. Right? Recession
Yeah.
doesn't always mean terrible market either.
Like, Jay, what happened? I know, if we July 90 to March 91, if we look and we say, what happened during that period? Like, how bad did the market actually get?
I mean, if you look at that period, the market was actually up, right, from up a few percent from start to finish. In the middle there was a dip of, what do we say, 18%. But, from that period start to end that you just mentioned, it was actually a positive period in the S&P. Wasn't smooth.
Yeah, no, it wasn't smooth. But all right, so July 90, the S&P was 359. Isn't that crazy to think the S&P was only 359 points?
Oh, it's 359. Yep. July.
Yeah, it was 359.
Yep.
But it was July of 90 at the start of the recession, based upon the NBER committee. S&P was 359. By March of 91, when they said it was over, it was 370 and change. That's up about 4%. And yeah, some point in that period, the market went down to 295, which is a negative 17.8% decline. I will say too, Jay, what's interesting, you and I looked at a year out. So July of 89 to July 90. And I think we said the market was up 12% prior to that. So I don't know, like one school of thought says, yeah, we're inverted right now, and maybe it's not going to work this time. And maybe it doesn't work because everyone now is saying, oh, there it is. We're going to do a bunch of stuff because we know it's inverted, and nothing is right 100% of the time. But Jay, you and I are like a broken record on this. Like we could be in a recession already. We could have already been in a recession, and 7 months from now, the committee will tell us. And maybe the market decline was already reflective of that. Like, who cares? Really? It is what it is, but not every recession has to be bad. Not every recession is like the 2008, 2009 one. So I don't know, but it is odd. What I will say is that, and it goes to Jamie Dimon's point, he didn't say necessarily the inversion, but he talked about this idea of higher rates and what if they're higher for longer. Things do get a little weird when, in theory, people are having to pay out near interest rates and they're owning or collecting further interest rates. So you have this sort of mismatch. And in 1994, the thing that broke was Orange County. Orange County was, I think, borrowing short and investing long, and things got inverted and Orange County went bankrupt. And so I don't know. I mean, like if it does happen this time, it doesn't mean it has to be really bad, but it just really, the steepness of this, Jay, though, is striking.
Yeah, no, it is. You're right. It's pretty dramatic. And look, if there's any one of these that I would, say has the greatest level of accuracy when you look at uh, uh, you look at these inversions, yeah, it's this one. It's the 10-year and the 3-month is the one that I've always found to be most accurate, even though I kind of poo-pooed it a minute ago. I mean, Derek, don't you feel like this is like the most telegraphed recession ever? Right? I mean, can we not? I mean, there's nobody that is unaware that there's a possibility of this. So, like, how is it going to catch you off guard? Like, what's going to? And I get something will break. There's something that's going to break, right? We saw that in March with SVB, right? And some of the banks that had problems, but something else is going to go. I'm not saying there won't be that. I'm not saying there won't be turmoil, but the market doesn't seem to have a lot of fear of it, even though it's expecting that it's coming. As we're sitting here recording this, when I look at the volatility index, it's at the lowest level with a 17, 0.07 closing value here on Friday. It hasn't been that low for well over a year. So that's including, everything that has been going on. We have the lowest, short-term volatility prediction that we've had in a long time. So I don't know. Maybe it's all, it's buy the rumor, sell the news kind of scenario, and maybe it's not so bad. Hard to hard to hard to round out these sharp edges of some of this, scary data that we're talking about.
Yeah, I mean, like the market closed today at 41.37, which is why we were chuckling over the fact that we're talking about an S&P at 359. And we're roughly the same as we were in February of this year, and we're roughly the same as we were in August of 2022. So you could say, I mean, the market's sort of it's been volatile. It had the drawdown, to 35.77 in October of last year. But all right, the last thing on this 10-3 inversion is Tobias Carlisle, who's on the Value After Hours podcast. One of the things that he pointed out was on the timing of recessions post the 10-3 inversion. And according to what he was looking at, he said the recessions tend to start about 7 months to 15 months after the yield curve inverts, the threes, tens, and the median is 12 months. This inverted on October 25th of last year, so October 25th to 2022, which means 7 months out from that would be May of this year. 15 months out would be January of 2024, so next year. And the median would be October of this year. What is it with October, by the way? October's an
October
interesting month, right?
stinks. It's the worst month. It actually isn't on average the lowest month, but when you get the really big sell-offs, they happen in October. That's just when it is. Beware of October.
It is. We'll have to see what happens on this one for sure. But yeah, it's interesting. I mean, wouldn't you love for this not to be? I mean, obviously, you and I don't want a recession. We want the markets to go up, but it is interesting. You'd think it'd be kind of interesting for something that everyone makes so predictive to be wrong, right?
The market has a habit of proving the most people wrong. It's just the most, it frustrates the most people. Not that the market is an intentional being, but it kind of feels that way sometimes. And when everybody thinks something, that's the almost guarantee that it's not going to happen. I don't know what else to tell you about that one. That's just you and I've seen that time and time again.
I mean, you and I have talked about this before. Go back and use Google, but limit your search to a few months in different years and just put in the common predictions. We're going to see recession, we're going to see crash, and how many times people are wrong. If this was so easy, everyone would be just making money every year at rates that are so unbelievable. Doing macro, trying to pick individual companies, trying to time stuff, it's really, really difficult. So, all right, Jay, I was going to mention just real quick, and then I want to talk about a few of our recommendations. U.S. retail sales disappointed this week, but I've been pointing out for a while, Jay, that U.S. real retail sales, so the amount of retail sales adjusted for inflation, it actually peaked in March of 21. Like, I don't know why no one's talking about this, but maybe I'm the only one who watches real retail sales, and that's okay if you tell me that. But even the nominal numbers were lower on a year-over-year basis, lower than they've been since sort of April or May of 2020. I mean, this is one of the things that the NBER, the National Bureau of Economic Research, looks at to declare recessions. I mean, this is telling me that we peaked in March of 21 on real retail sales. Do we make anything of this, or just another data point?
No, well, look, I do think you have been talking about this for a while. That is absolutely true. I'll back you on that. Um, look, one of the things that the Fed is trying to do is slow down the spending of the consumer on a real basis, right? Adjusted. That is happening already, and I think the market is reacting like this. This week we recorded this. Last week when you hear it, the retail sales numbers were a little disappointing, and the market didn't react well to that. So I think you may start to see this as the first, bad news is bad news, kind of a situation, right? We've been in this period where bad news is kind of good news because then it means, oh, the Fed is doing their job and they've impacted and they're going to stop, which eventually actually means good news. So bad news being good news has been around, but I think we're starting to see this little bit of a twist and turn where bad news is bad news, and that's what happened with retail sales numbers this past week. And I don't think it's a rosy outlook when it comes to that. And you could say, the consumer did kind of spike up quite a bit on their spending in 2021, but it has really leveled off. I don't think you're wrong. Now, I don't know how much of this is due to supply chain and availability of what they wanted to spend on. I think initially that had a lot to do with it. It was not that it was hard to spend your money, but you couldn't really go on trips, right? You were restricted because of what was going on in the environment, or you couldn't buy something because it wasn't available. But now, we're talking like 2 years later, March of 21 to March of 23, April of 23, sorry, even more than 2 years. You have to start to believe that it is definitely impacting behavior, that we are seeing less spending in the retail space. No doubt about it, Derek. And I think that ends up leading to, a contracting set of earnings. Not always great for the market.
Charlie Bolello had a chart out. we're actually referencing a few of his charts this week. So good job by him this week. And he points out, and I think it was him who made a comment or somebody else commented on his chart. We've actually had 24 consecutive months of negative real wage growth. In other words, adjusted for inflation. And I think somebody made the point, like, doesn't that give the Fed cover to still raise rates because they're like, oh, well, people are earning more, but it's still not outpacing inflation. I don't know. We'll see what happens with that.
I know it's an important point to talk about the earnings, because that's the thing about inflation, right? Like, the thought here is you don't want it to really get it. It's stickier, right? It's probably one of the stickiest things when it comes to inflation. And so you're right. It's good that it hasn't, got to the point where the Fed has to really clamp down on that. So I don't know if it gives the Fed cover or not, Derek. Because my 2 cents on this is they're still going up, right? Wages are still going up, and that will still be there once, if and when we get inflation back down to the 2.5% range. Those wages will still be higher, right? Which is part of the reason why things just in general inflation remains higher. The only last point, it's not even a good point, but I'll throw it in there anyway when it comes to this. There's a lot that goes on with workforce availability and a lot that goes on with job switching. And you've covered this in previous podcasts where you actually are incented to switch jobs more often right now in this environment, aren't you?
Oh yeah. I mean, I think the job switchers, their wage gains are much higher than the job stayers, right?
Yeah. And so I think that is even artificially pushing up. Maybe it's not artificial; it's a real number. Is pushing up that wage, number to be closer, right? For the to show the increase. But I don't know. It's hard. There's so many different moving parts when it comes to wages. You just gotta take them as they come.
All right, Jay. Well, let's talk about if we have anything that we think the audience should be. Any recommendations, Jay? Besides just,
Yep.
I don't want to talk about. I don't want to give away anything about Succession, but like if you're
Oh
not
my God.
watching that, you need to be watching that.
Yep. Okay, so I would say, The Mandalorian continues to be really good this year. So I'm definitely on that one. But I did see the Air movie.
Oh, how
Uh,
was
uh,
that?
it was pretty good. Listen, it was nice. It wasn't a 2.5 hour movie. They got it done in under 2 hours, which was very nice. No, it was a good inspirational business story. For those that don't know what it's about, it's the story of how Nike got Michael Jordan to be there. Actually, he's an employee, right? He got paid to wear the shoes as an employee, I believe, of Nike. And so, yeah, it's the story when I didn't realize this, but Michael Jordan absolutely did not want to sign with Nike at all, no matter what. And it's a great story of how the Nike team was able to change that dynamic, and then what a huge impact that shoe has had for all athletes going forward on the way that athletes create do deals. So it was good. It was good.
I mean, we wore Air Jordans like when I played high school basketball, and we'd all have the same shoes, and we didn't get them for free, but you'd sort of order them, and then you'd want the colors of the school. And I remember wearing those. I mean, that's what everybody wore back then. And there's
Yeah.
people collect them, which I wish I would have kept my used ones. I could probably have sold them. Who knew back
Then you
then? You
wouldn't
just
have
tossed them. Yeah. I
them.
mean,
Yeah.
so
Yep.
Sonny Vaccaro is really an interesting character. I know sort of the movie's about. I'm familiar with that story, but Sonny Vaccaro, I think, was the guy who, for schools, like he would go and get certain schools to use Adidas or Nike and stuff like that. So kind of an interesting character. That's
Yeah,
a
a
whole.
lot of information and the influence that he had on the industry in the movie. Yep,
Yep.
absolutely. He's the main character.
All right, so I kind of have an odd recommendation, but I think people, if they have not watched baseball in a while, they should check it out. Have you watched any games, Jay, with the pitch clock? It's awesome.
I have not. Wait, you're saying it's awesome?
I'm saying the pitch clock is awesome. You know
Okay.
what the pitch clock is? So
I do know
this
what the
year,
pitch clock is. Yes.
yeah, I love it. I mean, it's because when we watch, late 70s, early 80s, It's like, you're watching Ron Guidry pitch at Yankee Stadium, and he pitches, throws a pitch, the catcher catches it, throws it back, and Guidry takes a sign, throws it in again. And it started to get where there were 30 seconds, 40 seconds, 2 minutes sometimes in between pitches. And it was just ridiculous. So this pitch clock, the deal is it's once a pitcher delivers a pitch with nobody on base, catcher throws it back, pitcher catches it, you get 20 seconds before it, to throw the next pitch. And if you don't do it, an automatic ball is counted. And the batter also has to be in the box and ready with at least 8 seconds left on the pitch clock. So if you haven't watched baseball in a while, I know you're not the biggest baseball fan, it's so much better to watch. I think it's really good.
Okay. Well, I'll find a game to watch.
Don't you have the Marlins down there? The Marlins are your team, right?
Are they?
In Miami, right?
Yeah. I'm kidding. Yes. I'm trying to insinuate how little I watch baseball.
Yeah. The problem with baseball still remains from the steroid era, all the records that got quote unquote jacked up. Like for the, baseball was about numbers, about statistics. And I don't know how you ever get back from that because some of those records don't mean anything. But anyway.
My problem is only like it's hard to commit to a sport that's got like 160 games, right? It's a lot. Like football's nice. I got 17 games and maybe some playoffs and then good. But hard to commit to following out all that action that happens throughout the week on baseball. I think it's always been my challenge to it.
I mean, the market has 251 trading days.
I am absolutely committed to that. That takes up all my capacity, my friend.
There you go. All right, everyone. Well, thanks for coming on again, Jay. Appreciate it.
Yep.
And for everyone else, we'll talk to you next week. See you, everyone.